Good morning, I'm Carol Harmer from Charmer Trading, and here is my midweek video. And what I'm going to look at today for you is the S&P, a little bit of gold, and if we've got time, another currency apart from the euro, which I'm sure we're all dying of boredom with. But first of all, I'm going to go through the S&P with you because we are at quite interesting levels, and we're at quite interesting chart pattern as well. So I will just pop over and put you onto the chart. So initially I'm looking at the monthly. Okay, you can see here where we've broken up through this here. Now I have had a measured target on the S&P of 30.31 for quite some time. It was a Fibonacci extension when we made all-time highs here. Okay, so although I can make another fib extension here and here, I want to look at what this bit offered on the projected upside targets. Now with the S&P, we have had quite a year, well, we've had quite 2 years really, but what we're seeing in the indicators is we are diverging. Now obviously, this being a very long-term chart, you can see from 2016 to 2018, these didn't move. They were at extreme high levels, extreme high levels. Now, obviously, in a bullish market, this is to be expected if you look at what the indicators mean. An RSI is the relative strength indicator. So therefore, if you're in an uptrend, you expect it to be at the higher end of the spectrum. And that doesn't mean to say we're going to have a crash. What it means is just what it says. It's a relative strength index. You all should know what stochastics are. They take the daily high, low, open, close of a 10-day period or 10-month period or whatever time frame you're looking at, and they put it against an indicator of the 333 up line, K line, D line, and therefore that's what makes up a stochastic. Now these were at extreme overbought levels in 2018, and we saw what happened in 2018. We spiked and we came down, we went up, we spiked, and then we came all the way back down here. Now this, if you look at the indicators with you, the stochastic and the RSI, you can see that on the peaks, these haven't quite managed to get up there. And that RSI on the monthly, this is what the long-term trader is going to be looking at. This is not what short-term traders are going to be looking at, because it's the guys that run this market, it's too big. They have too big a position to switch. But what they're doing, I know because I was doing it as well, what we would be doing would be looking at this very, very carefully. Now, one of the rarest topping formation is what we call a broadening top. And this is what we have been seeing. And this is, if you look at the ranges, I mean, I can go back further, but if you look at the monthly ranges, you can see since 2009, we've been quite steady, all right? And what you expect with waves or uptrends, this 18-month period has been unprecedented in the daily ranges, the weekly ranges, the monthly ranges. I've been trading since 1982. It's nothing like I've ever encountered before. Now, this, as I say, is a very rare pattern. But the interesting point is at the end of trends, markets make huge swings one way and then the other. That's how you determine it. If you look at any of the technical analysis books, patterns, whatever you're looking at, this is one of the things that technical traders look for to determine whether or not the market is still going to go higher. For me, at the moment, I'm not going to stand in front of the speeding train. I may do at 30.31, But everything I'm looking at on this long-term charts is telling me that we're in trouble on the US stock markets. Now, obviously, that was the monthly chart. So how to take advantage of this scenario to be able to trade it, not intraday I think so much now, but to trade it from taking a position. So now I'm going to show you the weekly chart. Now on the weekly chart you can see two things happening. One, again, we have not taken out these highs. It's diverging. The RSI is starting to tick down from very neutral levels. At the moment we're trading on the RSI at 66.85, which is very undervalued. You know, if a market's 90% overbought, obviously we have a look at, it gives a clearer signal. Now you've seen the monthly on this, now look at the weekly. Head and shoulder patterns can also be continuation patterns. So you've got the monthly chart telling you one thing, but you could be having this inverse head and shoulder pattern that is telling you something totally different. What we could be seeing here is at the end of the 2009 bull run, this big pattern here could quite easily be construed as an inverse head and shoulder pattern. Now with inverse head and shoulder patterns, they determine the end of a trend at the bottom of a bear run, but they can be used as a continuation pattern within a bull run. And that's what a lot don't understand. It's quite easy to get your head around, because if you know about patterns and chart patterns and continuation patterns, you should know that they appear quite regularly in weekly and daily charts. Now knowing this, we can take advantage of it, because if a chart pattern breaks, we have a measured target. You know, all patterns have a measured target, a measured objective, okay? Now, normally with these measured objectives, targets, whatever you want to call them, they normally can be tied in with prior, let's talk about the S&P, before it made all-time highs. It can be tied in with prior highs. It can be priced in, the resistance can be done on pivot levels, Fibonacci extensions, you know. But if you see this pattern that is emerging, so you've got two trains of thought here. You've got on the monthly diverging indicators and a big broadening top. On the weekly you have an inverse head and shoulder pattern, which can and does be used as a continuation pattern. Now these patterns are quite easily identifiable. Where the problem lies is the fact that there are very few that have done enough research and analysis to know that you can have a inverse head and shoulder pattern that is in a bull run as a continuation pattern. And now all you do with this, you take that high there, you can see that shoulder's been made, okay. Up we go, we make a new high. Down we go to there. Up we start to go to around this area again. But the neckline has to be sloping higher. So this is where you're coming in to this 30, 31, 30, 40 area. So let's say, how would we measure this? How can we measure where our objective is? It really is quite simple. You take this high here, which is 29.40, you subtract that low there, which is 23.46. You know where the neckline's going to be, which is up at, let's give it some room, 30.45. And all you do is just take away the difference of points between the previous all-time high and that low there that was just cuddled and kissed by the 200-week moving average. That is a total of 594 points. Now, you can't do it now, obviously, but normally, which we did, was we bought down here at 2804 and run it. Obviously, we didn't run it as much as we should have, but traders do use these because you can just eyeball that chart and you can see shoulder, head, shoulder, neckline. Now, if that takes out then 30.45, you then have a measured target of 36.40. Okay, and then how you gauge how long it's before it gets there, you look at the pattern, and however long the pattern has taken to form, and this has taken 18, 19 months to form. So what you would do is you would expect this, if it breaks there, to reach its target area within 6 months. I know. If it was on the other end of the spectrum, if we were looking at it bearishly, which I'll go back to the monthly, you would see the bear market so much quicker, because for some unknown reason, traders are always wary of holding longs with the market going down. They want out. They feel safer selling. It goes down quicker. There was an old saying, up by the stairs, down by the escalator, and that has not changed in all these years. So we have our target from the weekly chart if we break that 30.44 area. And you can see where I've drawn the line. It's very easy. It is not rocket science. Just draw the line. Connect the tops. Right. Just connect them. People say about trend lines and they've got to do it. Look, if you see 2 points on a chart, on a weekly, draw the line in. There you go. It'll go to the line. If it goes above the line, then obviously we're looking at 39, 36. So 36, 39. There you go. 36, 39. Now let's go back to the weekly and the monthly and see if we're going to turn into a bear market. Now on this chart, you have got some pretty hefty downside potential, but you will only know if this market is going to absolutely tank if we go below here. Now obviously that's just too ludicrous to do it on a day trade, but the broadening top is what it is. So we are now testing the top of the broadening top. If we cannot break, it's going to test the downside. You've got the same length of time on this pattern as that what you have on the weekly. It's took the same amount of time to form. So the same amount of time scale would be the same as if it's going to go up, but you would see it go down more sharply, whereas you'd see it rise in steps on the bull side. If we cannot break up, you will see a big move down within 6 months. Now, where this becomes interesting is if we take out 2200. That's a long way away, so I'm not even going to go that way to be able to trade. But my point is that you can use charts, you know,